You have money sitting in a savings account right now. Maybe it's $500, maybe it's $3,000. Maybe you've been genuinely disciplined and built it up to $10,000. And that savings account feels safe. It feels responsible. It feels like you're doing the right thing. And you are, partially. But here's what nobody tells you about money that just sits there. It's shrinking, quietly, invisibly, every single month. And the gap between being a saver and being an investor is the single biggest financial difference between people who build real wealth and people who stay comfortable but never actually get ahead. Today, I'm going to walk you through the exact step-by-step path from saving to investing. Not the theoretical version you've heard 100 times, the actual sequence, the numbers, the order of operations. Because most people know they're supposed to invest. They just don't know where to start, in what order, with how much, or when. And that confusion, that paralysis, costs the average person somewhere between $300,000 and $500,000 over a working lifetime. I'm not making that up. I'm going to show you the math in a minute. My name is Nick, and I spend way too much time thinking about money, compounding, and why some people build real wealth over time, while others just spin their wheels saving the same $5,000 over and over for 15 years. If that sounds familiar, hit subscribe. Because what I'm about to walk you through will actually change how you think about the money you already have. Let's start with the real problem. Your savings account is probably earning somewhere between 0.5% and 5% annually, depending on whether you're in a high-yield account or a regular bank. Meanwhile, inflation runs around 3% to 4% per year on average, which means if your savings account is earning less than inflation, and most standard savings accounts are, your money is literally losing purchasing power every single year. It buys less stuff in 5 years than it does today. That $10,000 sitting in a regular bank savings account for 10 years at 0.5% interest becomes about $10,511. Meanwhile, the S&P 500 index, just the 500 largest American companies, has averaged roughly 10.5% annually over the last 50 years. That same $10,000 invested in an S&P 500 index fund for 10 years becomes approximately $27,000. Same $10,000, same 10 years. The difference is $16,500, just from where you put it. That is what staying a saver instead of becoming an investor actually costs you. Now here's the part that genuinely bothers me. Most people who save well are not bad with money. They're actually really good with money. They budget. They don't overspend. They're disciplined. But they're stuck in saver mode because investing feels risky and savings feels safe. And I understand that completely. The stock market goes up and down. You can watch your balance drop 20% in a bad month. That's genuinely uncomfortable. But here's what people don't weigh against that discomfort: the invisible, painless, silent risk of not investing. Inflation doesn't feel like a loss. Your savings account balance doesn't go down. It just quietly stops being worth as much. And that is far more dangerous than market volatility for anyone with a long time horizon, because you don't feel it happening until it's already cost you years of compounding. Before we get into the steps though, and this is important, I am not saying don't save. The emergency fund is real and it comes first. Because the number one mistake people make when they move from saving to investing is they invest money they actually need. They put $5,000 into the market dips 15% in a rough month, and they panic sell because rent is due. And now they've locked in a real loss and they're worse off than if they'd never started. The buffer has to exist before you invest, non-negotiable. Here's the exact order of operations. I'm going to be specific. Step 1. Get your emergency fund to 1 month of expenses, not 6 months, 1 month. For most people, that's $2,500 to $4,000 in a separate high-yield savings account you do not touch. This is the floor that keeps a $900 car repair from becoming a credit card spiral. Until you have this, you are not emotionally or financially ready to invest, because the first time the market dips, you will sell. 1 month first, everything else after. Step 2. Capture your employer 401k match. If your employer matches your 401k contributions, even 50% of the first 3%, that match is a guaranteed 50% to 100% instant return on your money before a single investment plays out. Nothing in the market will consistently beat that. If your company matches 3% and you're contributing 0%, you are turning down free money every single paycheck. Contribute at least enough to get the full match. If you don't have a 401k at work, skip this step and go directly to step 3. Step 3. Open a Roth IRA. A Roth IRA is the single most powerful investment account most Americans have never actually used. Here's why it's remarkable. You contribute after-tax money, money you've already paid taxes on, and everything that grows inside that account compounds completely tax-free. When you retire and withdraw it, you pay zero taxes. Zero. The government gets nothing from decades of compounding inside a Roth. The contribution limit is $7,000 per year in 2025, about $583 per month. You don't have to hit the maximum right away. Start with $100 a month if that's what you have. The account just needs to be open and funded. Step 4. Put that money in an index fund. This is where most people freeze. They open the account, deposit money, and then leave it sitting in cash inside the account because they don't know what to buy. Opening the account is not investing. You have to actually buy something. And what you buy first, before individual stocks, before anything else, is a broad market index fund. Something like VOO, FXAIX, or VTI. These track either the S&P 500 or the total US stock market. Low fees, massive diversification, and decades of proven long-term performance. One purchase gives you a tiny slice of 500 of the largest companies in America simultaneously. Do not pick individual stocks before you've done this. Not your favorite company, not whatever is trending on finance social media this week. Index fund first, always. Step 5. Automate it. Set up automatic contributions on a schedule that aligns with your paycheck, weekly or bi-weekly, so the money moves into your Roth IRA and buys index fund shares before you have a chance to spend it or second guess it. This is called dollar cost averaging. You stop trying to time the market, which nobody does consistently, not even professionals, and instead you buy consistently at whatever price the market is at. Some months you buy high, some months you buy low. Over time, your average cost is reasonable, and you capture the long-term upward trend without the anxiety of trying to pick the perfect entry point. Automate it. Forget it. Check it quarterly, not daily. Step 6. Increase contributions every time your income increases. Every raise, every bonus, every side income dollar above your normal expenses. Redirect a percentage of every income increase into your investment contributions before your lifestyle has a chance to expand to absorb it. This one habit is the biggest accelerator for wealth building outside of just earning more. When you get a $300 per month raise, automatically put $150 of it into your Roth IRA. You never had it before, so you won't miss it. But in 20 years, that extra $150 per month compounding at 10.5% annually is worth an additional $115,000 from one raise, one decision made once. Now let me show you what this path actually looks like over time with real numbers. Because I think most people genuinely underestimate compounding until they see it laid out. If you invest $300 per month starting at 25 into an S&P 500 index fund at the historical average of 10.5% annually, by age 65 you have approximately $2.1 million. You personally contributed $144,000 of that. The market generated the other $1.96 million. Time did the heavy lifting. Your only job was to start and stay consistent. If you wait until 35 to start that same $300 per month, you end up with approximately $770,000 at 65. Still a lot of money. But you left $1.3 million on the table by waiting 10 years. 10 years of being a saver instead of an investor. $1.3 million. Gone. Not because you did anything wrong, just because you waited. Here's the mistake I see play out constantly, and it genuinely frustrates me. People understand the concept, they agree with the logic, and then they spend 3 months researching which index fund is the absolute best before opening anything. They wait for the market to settle down before putting money in. They tell themselves they'll start next month once they understand the tax implications better. And next month becomes next quarter, becomes next year. And then 5 years have passed and they're doing math on how much they missed while they were researching. There is no perfect time to start. There is no market condition that makes it objectively safe to begin. The best time to start investing was the day you got your first paycheck. The second best time is today, and the amount matters far less than the habit. $50 per month invested in an index fund is infinitely more powerful than $0 invested while you wait to have more, because the account that's open and funded is the one that compounds. The account you're going to open when things settle down is worth exactly nothing. The path is not complicated. Emergency fund first, employer match second, Roth IRA third, index fund inside that Roth fourth, automate fifth, increase with every raise sixth. That is the whole thing. You don't need a financial advisor to execute this. You need a Vanguard or Fidelity account and about 30 minutes this weekend. Every month you wait is a month of compounding you never get back. The savers who become investors are not smarter. They're not luckier. They just started. Go start.